Welcome to episode 3 of Keeping It Real. I'm your host, Adam Tabaka. Today, we're examining the 4 benefits of investing in real estate with Forrest Odendhal. Forrest is the managing broker at Long & Foster in Old Town Alexandria. He's an expert in the fields of residential real estate and investment real estate, with 31 years of experience serving clients in Northern Virginia. From 1990 to 2010, Forrest consistently sold more than 100 units per year, and in 2003 was recognized by Realtor Magazine as the number 41 agent in the entire nation, with 133 settled units. Forrest was the president of Prince William Board of Realtors in 2011, served on the board of directors, and was the RPAC chair for the Virginia Association of Realtors from 2012 to 2016. And next year, he'll be inducted into the National Association of Realtors Hall of Fame. A father of 2, a grandfather of 3, a personal mentor of mine, he fought in 3 amateur boxing matches, enjoys fitness, and loves real estate, investing, and teaching. It's an honor to present the one and the only Forrest Odendhal. Forrest, thanks for joining us today.
Thank you, Adam. That was very nice. Thank you so much. I appreciate it, and I'm thrilled to be here.
All right. Well, now, Forrest, you've been in the real estate industry for 31 years, which is impressive for someone who appears to be 40. Give us a little background about yourself and how you got to be where you are today.
Well, I was a criminal justice major at Salem College, played football there at Salem. And when I graduated, my professor said, hey, if you really want to know police work, you need to go to one of the big cities. So I applied at my hometown police department, came out number 1 in that process, and was hired and served from 85 to 89 with the Manassas City Police Department at 14 years. And while I was doing that, I always had a drive to do something else. So my rookie year, I talked to a corporal, Don McKinnon, and I said, hey, we should start a fitness center. And so we start the Powerhouse Fitness Center, and we owned that from 85 into 89. And what I learned is when you have a fitness center, you got to cover a lot of hours. So we sold the fitness center, and I thought, let me do something that I only have to count on myself. And so I decided to go ahead and take the real estate class. Now, at that point in time, the class was offered at the community college. But once I passed that in March, I did both real estate and police work full-time for 9 years. So from 1990 March until March of 1999, I did both and was able to really have a real decent career by putting forth the effort in both of those.
That's a lot of work. It's quite a work ethic you've got. So tell us, what are some of the ways that maybe your previous law enforcement experience may have made you a better salesperson and manager in the real estate industry? Well,
as police officers are in situations, so the job of a police officer, you get called, you're the last call somebody's going to make, and when you get to the situation has to be resolved. So you're actually trying to communicate with human beings, probably at the worst time of their life, to communicate with them and get anything positive that you're going to be able to utilize out of them to try to resolve this situation. And so by having those communication skills and going to actual trainings about interview techniques and that sort of thing, being at the police department, I really focused heavily on that, and it really improved understanding people. So then when I got into real estate and I'm dealing with a buyer and a seller, it seemed pretty simple. Nobody was going to go to jail. Nobody had been victimized. And your communication skills, you understood people and you could communicate with people. You're just trying to help people. A seller just simply wants to sell their home, and a buyer wants to buy a home. So it was a whole different dynamic. I really think that a good police officer, a good detective, would be an exceptional salesperson, especially in real estate, because they understand people. And isn't that really what we're doing all day? Is whether it be with our agents or with the consumer, we're just having good communication and we're listening and trying to solve problems.
Makes sense. Makes a lot of sense. So before we delve into today's topic, real quickly, just curious, What do you see as the maybe the biggest misconception that the general public might have about working as a real estate professional?
So it's a very highly taxed job. You only get paid if you succeed, and no other benefits come with it. There's no retirement, there's no pension, there's no health benefits, nothing. So to make 100 grand in real estate is probably equivalent in another profession to make maybe to make 65 grand.
Okay, so let's talk about today's topic now. The 4 benefits of investing in real estate. If you would kindly give us a brief overview of each of those, and then let's delve a little deeper into each one individually.
Thank you, Adam. I'll be glad to do that. And let me just say that Tom Lundstedt, I was in the business. My friends and I we thought we were investing in real estate by buying real estate and selling it. So we'd buy maybe a townhouse, or I would guarantee somebody a sale. I'd say, look, if I can't sell your townhouse, I'll buy it. And then you will have the money to move on into your next home. I don't want that to be the reason. We weren't always, in the last 31 years, it wasn't always this market, Adam. I can tell you, interest rates weren't below 3. As a matter of fact, from 1971 to current, the average interest rate, 8.08% is what it would be. I remember a lender once told me if we could just keep interest rates right at 10%, that would be awesome. I paid points one time to get 9.75%. And I thought I just got the best deal ever as far as interest. So we've been through different markets. You have a buyer's market where the buyer's, in the driver's seat, and then you have the seller's market. So, a lot of the time when you're in these markets, you have to be creative. One of the things that I did was I put myself in a position that I was able to buy a property if I wasn't able to sell it. Now, I was successful in selling a lot of properties, but occasionally I would have to make that guarantee and buy one. And then once I bought it, we may rent it. But generally what we would do is just go ahead, the folks would move out, and then we'd sell it. When I say we, it was either myself. Sometimes I would partner with a lender. I would partner with a contractor. I would partner with somebody else that was in the deal that had an interest in the deal. So if we needed work done and I partnered with a contractor, we could get work done at cost and we wouldn't be paying retail. So went ahead and flipped this. And I thought because of that, I was a real estate investor, but I really wasn't a real estate investor. I was just a speculator. I'd buy a property. Hopefully I could make a profit after I helped the folks out get into another property. Whatever amount of money that we made, we would be taxed on, and it would just be taxed as regular income. It wasn't until 2009, I had been in the business, licensed in 1990, and here I am, Adam, 19 years later, I'm in leadership with Prince William Association of Realtors. And I go into this class, a VAR function, Virginia Association of Realtors function, and this guy, Tom Lundstedt's in there, and he's saying, hey guys, let me tell you, this guy was a former professional baseball player. If you can ever hear Tom, if you ever have an opportunity to hear Tom speak, you want to do it. He's just an awesome guy. And he said, look, there's 4 benefits to investing in real estate. You have income, you have principal reduction, you have income tax savings, and you have appreciation. And all 4 of these working together is why real estate is a great investment. And at that point, really what all we're considering is the income piece. We're saying how much money is going to come in every month, how much is it going to cost me? And just considering that factor may be the deciding factor on not buying a property that may be a really good real estate investment. So if we were just to take the income of the property, which would be the first one we'll take, you're saying, something, what is the income of this property, or what could the income be compared to what it's going to cost? And of course, the higher the interest rate and the leverage and that sort of thing may make that a negative number. So that's the income piece. We then say, okay, well, what is a principal reduction? Well, every time I make a payment, there's going to be a portion of that payment that goes towards interest and a portion that goes towards principal. And every time I make a payment, so the tenants make a payment to me, I then make a payment to the lending institution, and the lending institution collects interest and they collect principal. And every time the payment is made and the principal reduces, The next payment, I'm paying a little less interest because they can only charge you the percentage of interest on the amount of money that you still have. And the principal reduces even more. So the principal reduction, every time the principal reduces, my net worth's going up. I'm getting richer. So I thought, even if it cost me a few $100s negative on the income side, maybe I wouldn't have bought this property, but just considering principal reduction, maybe it's not so bad because I'm reducing the principal at a greater rate potentially than I'm actually losing money on the income side. Also, every year, I'm going to raise the interest. I'm going to raise the payment 3% because I'm going to consider the fact that inflation is going to take effect, and I want my dollar to still seem like a dollar. And over the last 100 years, inflation's been about 3% per year. So every year, I'm going to raise it 3%. As I raise it 3%, and my payment stays the same, I'm actually now narrowing down that negative amount, and I'm still getting the principal reduction. Then we have income tax savings, and this is really the one that you really want to get your head around. The government says, look, the home ownership rate is, let's say, 67%, which means we have 33% of the folks that have to rent. And if those folks have to rent, we better have a place for them to rent. The government certainly doesn't want to provide housing, so they want independent people to invest in real estate. So by investing in rental property, the government says, look, we know you're taking a risk. We would like there to be some advantage. So if I invest in residential real estate, I get to depreciate that real estate over a 27.5-year period. If I invest in non-residential, it's 39 years. But if I invest in, let's say, a restaurant building, then it's 15 years. The shorter amount of time, the better it is because the more you can write off with the depreciation. So depreciation is simply a number attached to property by the government, allows you to depreciate the property and save tax dollars. Well, that's huge. So now in addition to principal reduction in income, now I actually get to save tax dollars that I get to keep in my account rather than paying the government. And they're doing that because I'm taking on the risk of providing something that is needed for our economy. And then the next one, and the last one, is simple appreciation. Larry Kendall from Ninja Selling, Adam, says, there's a thing called the equilibrium theory. Real estate over a long period of time in the United States will appreciate 5% per year. And so if it's appreciating 5% per year, and the average, the average as far as inflation is 3% per year, then owning real estate is a huge advantage. So just consider if I have a $100,000 property and it appreciates 5%, it's appreciated $5,000. Well, now next year, it's 5% of the 105. And this is why I think the net worth of a homeowner exceeds $280,000 because it's a difference between what that property is worth in the United States compared to what they owe. And that gap represents most of their net worth. And that's why the difference between a homeowner and a renter is so substantially different. And it's just simply because of that property appreciation and the principal reduction as they're making the payment.
Excellent. Thank you. That's a fantastic rundown on everything. Now out of curiosity, what do you think is behind, what do you think propels the long-term trend where home appreciation has outpaced inflation over the long run? And is that sustainable indefinitely?
Well, I went back, the chart that I found that I could put my hands on actually was in 1963. Okay. I did the new homes sales, and it gave a chart from that point forward. And in 1963, the new home sale was the average was 18,000, and I applied the 5% rule to that, and it actually, if you apply it to that, the new home sales chart, it actually appreciates even greater than the 5%. But I think it really comes down to any appreciation in real estate. There's a couple things that really have a big impact on it. And the first is supply and demand. When there's an abundance of supply and there's not a huge amount of demand, you're not going to have great appreciation in those years. And then today we have such a small amount of supply and such a huge demand that we're seeing double-digit appreciation. So I think if you take the totality of all those and know that the equilibrium is going to be somewhere in the middle. Also, it's something that you can't just make more of overnight. So if a company says, "Hey, we need to increase our production of a product," they pretty well can determine how much product comes out. Whereas if you're trying to increase housing, it is a much longer process. And because of that, because it takes the builders building the product and all that, you have the actual growth of your population, you have job growth, you have such a desire to be, let's say in an area, Northern Virginia area, now supply and demand switches very much in favor to the seller. We can't quickly correct that. It takes time for the builders to build where that pendulum comes back the other way.
Oh, these are excellent points. You mentioned early on that there are, a lot of maybe novice investors kind of just look at the income piece when they're looking at the benefits of investment real estate. Kind of in your experience in talking to new investors or prospective investors, I mean, how many do you think only really look at that the income piece of it without really recognizing the other benefits that are associated with investing in real estate?
Yeah, I think, I've done a real estate seminar. We've done from Jersey down Long and Foster's footprint down to Raleigh, North Carolina. And it was, what I found is over 1,500 agents have taken the seminar and they just don't know. And so the income part of it is the simplest part. People get that I have to pay money to own something. And if it's going to generate money, I need that to balance. So people understand that. They understand money in, money out. They deal with that. They deal with that daily with their jobs. I got so much money coming in, I can only have so many bills. And they condition themselves to understand that. And I don't think that the generations in the past have known these things, just like I didn't know. My parents didn't pass on any of this to me. This was something I had to take an interest in and learn. So I think that just the common sense of it is, this is going to generate money. This is going to cost me money. Where is that balance? It isn't until you really start looking a little bit deeper or somebody educates you on it to understand. So when I make that payment, what are the components of that? Okay, well, now you have a benefit, principal reduction. I've always turned my stuff into my accountant. I don't know how it turns out. Well, then you don't understand depreciation because you've never had to personally apply it. And you may not even know that it's a benefit because maybe nobody in your family or nobody that you know has ever had investment real estate to even understand that they can get depreciation. Most people will just have the home that they're in, and you can't, and these benefits do not apply to the home that you live in and you reside in. So you have the depreciation, just the principal reduction they don't understand. The part they do understand is, hey, every time I bought a property and we've owned it for a while, or my grandparents' property or my parents' property, it seems to be worth a whole lot more when they go to sell it in the future than what they paid for it. And the problem with appreciation in people with instant gratification is once the property value goes up and they see that they can make a profit, a lot of them are pretty eager to cash out. So you have to set a long-term goal and say, I'm going to hold steady to that long-term goal and hold real estate. There's a saying that says, You don't wait to buy real estate, you buy real estate and wait. And a lot of folks will see $200,000 or $300,000 worth of equity in an investment property and think, this is awesome. I could sell this and then put that money in my bank account, and I'll have that money in my bank account. It'll give me something to touch. I can actually hold on to the money. I'll see it in my account. And because of that instant gratification, they don't hold on to it for a long time.
Excellent points. Now, for anybody who's contemplating getting into the investment arena, or just wants to learn more, what are a couple of good resources, whether they be books or online or individuals, that someone should look into when they're really kind of thinking about getting into this?
Well, Googling it, there's the best book, I think, and the simplest book to understand an income producing asset, which is simply what a real estate investment is Robert Kiyosaki's Rich Dad Poor Dad.
Great book.
Really great book. But there's a lot of resources out there now with all this information available. So I think if you focus on those, there's a company called Entrust, ENTRUST. There's a thing called self-directed IRA. You can take your retirement account and actually invest in real estate. And for instance, my wife, Christy, now owns 3 condos she paid cash for. These are income producing assets, generating tax deferred income. She doesn't pay taxes on it. She's making the income. And she's paid cash for them with her IRA. And like I said, she owns 3 of those. If she was to sell them, she wouldn't pay tax on the gain she has, whereas generally you'd pay capital gains. So the Entrust is a great resource for that. But there's as far as investing in real estate, I would get there's the commercial real estate people understand this completely. I don't know of a lot of courses out there that specifically deal with this. I know Larry Kendall with Ninja Selling. He calls it Wake Up Money. He teaches a course on it.
Any final parting thoughts for our audience?
Yeah, I think that investing in real estate takes planning, and there was a great study done by Harvard. So you got to figure this MBA study was done, and it's from 1979 1989. They do this study, and they said, okay, they took 1,000 Harvard MBA graduates. Now, not only these cats went to Harvard, but they're MBA graduates, right? So they understand this. And they went ahead and did a study, and they said that when they did a study and they polled them, 83% of them had no specific goals. And 14% had specific goals but didn't write them down. And 3% had specific goals that they wrote down. And of the 14% with specific goals earned an average of 300% more than those without specific goals. And the 3% with specific goals that they wrote down earned 1,000% more. So the idea is, if you want to become if you want generational wealth, if you want to become a multimillionaire, real estate is a surefire way to do it. You have to set a goal. You're going to have to be patient. You're going to have to buy real estate, resist the urge to sell it when the prices go up. Because think of real estate as an income producing asset, and think of it as a money machine. When you sell your money machine, even if you get a good price for it, it stops making money. Somebody else has it. So all 4 of these benefits continue to work in harmony as long as you continue to own it. So resisting selling it I would say is probably the biggest goal. And if you do sell it, there's a thing called a 1031 exchange. Sell your investment real estate to get into a faster investment real estate wagon. Don't sell it just for the sake of selling it to take a profit, unless there's some other income producing asset that you're going to invest in that's going to be better than what you just got out of. So I'd have to say that's my parting thoughts.
Great stuff. Great stuff. Forrest, thanks so much for joining us today. Really appreciate having you on. Love to have you back at some point here in the future. You've been a great guest.
Thank you so much, Adam. I appreciate it, and I think you're doing a wonderful job with these podcasts. Have a great day.
Of course. Take care.
See you, buddy. Bye.